Today, we've got something important to talk about, and honestly, a lot of people are confused about it. YieldMax is doing reverse splits on some of their high yield ETF, and if you've been stacking these for the income, you've probably already seen alerts popping up in your brokerage app. So let's sit down, relax, and break this down. No overthinking, no complicated math, just a clear, simple explanation of what's going on. So, first things first, what even is happening here? YieldMax announced reverse splits on several of their ETF, and the moment people hear reverse split, they get nervous. But take a deep breath. This is totally normal for the kind of income-heavy ETF it runs. Before we talk about the split, let's quickly understand how YieldMax works. They build ETF that focus on income-using options. These aren't your typical long-term growth ETF. They're designed to collect income, pay it out weekly or monthly, and repeat. And because they pay out so much income, the share price naturally drifts downward over time. Nothing is wrong, nothing is broken. That's literally how these funds are meant to function. But here's the problem. When the share price drops too low, things start getting messy. Trading gets a little clunky, the ETF starts looking like a tiny price stock, new investors get confused, and everything becomes harder to manage. YieldMax doesn't want that. They want these ETF to stay in a clean, normal trading range so everything feels smoother, and that's where the reverse split comes in. Think of it like cleaning up your desk. Nothing new is added, nothing is taken away. Everything just gets reorganized so the space looks cleaner. That's exactly what a reverse split does. It takes the shares that already exist and bundles them together. So instead of having a bunch of low-price shares, you now have fewer shares at a higher price. The important part, your total investment doesn't change at all. It's like trading coins for bills. Same value, just packaged differently. A lot of people panic when they see their share count drop, but don't. The price per share goes up to match it. Your investment stays exactly the same. YieldMax even explains on their website that this is normal maintenance for ETF that pay out a lot of income. These funds eventually drift down in price because of the payouts, and when the price gets too low, they hit the reset button. That's it, nothing dramatic. Now let's talk about something else people always ask. What happens to your income? Because yeah, these ETF are mainly bought for the payout. And the good news is a reverse split doesn't suddenly cut your income. Since you now own fewer shares, each share's payout is simply adjusted. You end up in basically the same spot. Same overall income potential, same strategy, same everything. It's just scaled differently. The only thing worth noting is fractional shares. After a reverse split, some investors might end up with a small fraction of a share. Instead of leaving you with that weird fraction, your brokerage usually converts it into cash. Totally normal, nothing to stress about. It's just housekeeping. All right, so what should you do when YieldMax announces a reverse split? Honestly, nothing. Your brokerage handles everything automatically. You don't need to buy or sell anything unless you personally want to. One day you log in and your share count looks different, but your value is the same. Super simple. Now, here's something important. A reverse split isn't a sign of trouble. With companies, sure, it might be. But ETF are not companies. They're not trying to grow profits or avoid bankruptcy. They're just tracking a strategy. YieldMax isn't doing this because something bad is happening. They're doing it because a high-income strategy naturally pushes the price downward. So eventually, they tidy things up. People also ask if they should buy before the split or after. But here's the thing. The split itself doesn't give you any advantage. It doesn't make the ETF cheaper. It doesn't make it more expensive. It doesn't create a discount, and it doesn't create a bonus. The ETF is exactly the same before and after. So don't base buy or sell decisions on the split, base them on whether you actually like the YieldMax strategy. And that's where you need to know yourself as an investor. If you want long-term growth and slow, steady appreciation, these ETF are probably not your main tool. If you want income and you're okay with the share price slowly drifting down over time, then these ETF might fit your style. Just understand what they do. Option income ETF are very different from broad market ETF. Reverse splits don't change that reality. They just clean up the numbers. So here's the big takeaway. In the simplest terms, YieldMax doing reverse splits is completely normal. It doesn't change the value of your investment. It doesn't cut your income. It doesn't mean the ETF is failing. It's just a reset. That's all. Your shares go down, the price goes up, and your overall investment stays exactly the same. At the end of the day, nothing about the strategy changes. Nothing about your exposure changes. It's the same ETF, the same approach, the same income mechanics, just with a cleaner looking share price. So don't let the words reverse split scare you. It's part of how these high income ETFs operate. If you enjoyed this breakdown and you want more simple, honest ETF explanations, make sure to hit that like button and subscribe to Money Stick Unfiltered. Thanks for watching, and I'll see you in the next one.